Tony's story is, I would say, very unique in the funds management industry, and also the company that he's now created is very unique. And so one of the things that people don't know necessarily is that there are fund managers in Australia that do not charge management fees. And Tony is one of the few that fits that bill. So Tony, I think I'll just throw it over to you. Why do you not charge a management fee? You know, what makes you so inclined, I guess?
I'm passionate about alignment of investor interests with fund manager interests. There's a lot of funds out there that would be rightly accused of asset gathering, and so for different investment styles there are different levels of fund that will apply to that style. And what will often happen if you create a successful fund management business, everyone gets up and presents and talk about capital-light businesses. Fund management, if you get it right, is one of the most spectacular businesses in the world. You scrape together $1 billion and charge a 1% fee, that's a $10 million annuity income. If you can run your business for $3 million a year, there's a $7 million profit business with very, very little capital required. But the strategy that underlies that $1 billion fund may only be good for 300 million or 400 million of fund. But if you're the fund manager running that, what you want and what your investors want may not necessarily be the same. So the temptation as a fund manager is to run your business profitably, and if people are willing to keep giving money to you, that you keep taking that money. And the way I've set up my business and all of the businesses that will follow in the zero fee industry is that because they're charging no management fee, they will set the limit of their own capacity at the point at which they think they can earn the best return for their investors, which will in turn be the best return for them.
Wonderful. Okay. So the second question to Tony would be, and this is based on some recent performance. For those that don't know, Tony's transitioned to a new fund structure. Not recently, maybe a couple of years ago now.
It was August 2017. So the fund I originally set up was set up mostly for friends and family. There were 16 people initially that gave me $5,000. That was just a little starting fund. That was in April 2007. That was in April 2011. Sorry, and the fund grew substantially and got to the point where the vehicle that we put it in was not capable. So we raised $36.5 million in August 2017, and then had a terrible 18 months immediately afterwards.
And that was going to be my point, is that until recently Tony's fund underperformed, and for those who saw the opportunity, if you pay a fund manager zero management fee and they only get paid for outperformance and there's a high watermark, you don't pay fees as they catch up. So recently, I think it was, you shared yesterday or the day before, an update on his Twitter account which showed that Tony's fund has now climbed its way back to number one in its universe, so the fund universe according to Morningstar.
To be fair, the Morningstar have got me in the large blend for some reason, which we're in the process of fixing up, so I probably wouldn't be number one if we were actually comparing against small cap and micro cap managers, which is really what they should have me compared, but certainly I'm trouncing all the large cap guys.
Okay, so I guess this lends itself to a question, and I don't necessarily like to ask this type of question, but I think it's one that many people like to hear the answer to, and it's, given this recent performance, where are you seeing opportunity? What have been, I guess, maybe themes or companies that have jumped out to you?
Well, the most interesting thing, and I mentioned this to a couple of my investors that are in the audience earlier, is that we've had this 3 times in our history. We've gone through a 6 to 9 month hot stretch, which we've just been through, or we're hopefully in the middle of, and will continue at the moment. But the interesting thing about it this time, which is different to the last couple of times, is that the things that have driven that have not been what I was expecting. I was very confident at the start of this financial year that 2020 would be an excellent year for EGP. But the things that have driven the very excellent first 4 months have not been the things that I expected. So, you know, everything that we owned, the way that I run the portfolio is relatively simple. It sounds more mechanical than what it is, but in very simple terms, we're targeting an internal rate of return based over our expected period of investment of 20% per annum when we invest. Now, to be fair, when you do eventually put up my performance numbers, they won't look that good. We haven't got 20% per annum, although that's the target. We make mistakes and things don't work out the way that you think that they will. And in simple terms, when our expected rate of return on that investment gets below 10%, then we start to look for other things to put those funds into it. And what we really hope happens is that it stays in that sweet spot in between for years and years. And our average holding period at EGP is around about 9 years. So we don't have a lot of portfolio turnover, about 12% per annum.
You've been able to feed yourself over the last 18 months about getting your fees.
Well, I'm the largest investor in my fund. Now, we earn 3.46% from memory. You put it up, I'll see if I was right or not last year, which was not a good year relative to the ASX 200, which we underperformed. You can see that I've fed myself okay. We're the largest investor in our fund, and so my wife and I have all of our superannuation, all of our personal investable assets, aside from a few small other zero fee funds that we've invested some of our SMSF into. But basically, I would say 98% of our investable net worth outside of our family home is inside the fund, which is one of the key features of the way that I run money. One of the big questions people ask when they say, "Oh, you're performance fee only," that will make you take insane risks to try and earn a performance fee. Well, the way that I mitigate that risk is by having my entire investable asset base inside the fund. And so if I make a huge mistake in the fund, then I'm going to feel it a lot more than any of my investors do, unless some of my investors have 98% of their net worth in the fund, which I doubt they do.
What's the minimum investment?
$50,000. So we're a retail fund. We have a retail AFSL, and so we can take on retail investors. But I'm cheap in the way that I run all of these things, and it does cost. Unfortunately, I actually get a lot more pleasure out of managing the retail money than I do. I always say making rich people richer is good for a business, but I actually get more pleasure out of making regular folk wealthier. So a minimum set at 50,000, because at that point it sort of makes economic sense.
One at the back. Yes.
What investments have made the most money for your fund?
Over history, our best ever investment has been Dicker Data, which still remains, I think, our 6th largest investment. I watched that stock at IPO. It IPO'd at 20 cents, and I thought it was a very, very good and attractive business. It did what was effectively a compliance IPO. There was 95% was still retained by the 2 owners of the business, and as it happened, the rest essentially of the other 5% of the business got soaked up mostly by staff. So it was extraordinarily difficult to get that business. I started buying it maybe 9 months after IPO at 40.5 cents. So the stock had more than doubled at this point in time when I started buying. It was the first time in my history as an investor, and I've been investing for 12 or 13 years at least by that stage. It was the first time in my history I ever bought all-time highs, and I bought it all the way from 40.5 cents up to 54.5 cents, I think, and I probably spoke for half of the volume in the market over that 30% or 40% increase in the stock price. And that stock obviously now trades at around $7, and it's probably paid 70 or 80 cents in dividends over our holding period. So, and this is one of the things I say as a concentrated investor. If you stripped out our 5 or 6 best picks, then our performance would go from something like 6.2% per annum outperformance since the fund started back down to pretty close to the market. So it is important, if you're going to be a concentrated investor like we are, to occasionally get one right. So Dicker Data would be the biggest. We had a fairly large investment in Service Stream, which we bought at 18 cents and sold 2 years or 3 years later, unfortunately, at 90 cents. It went on to double again after that. So we made, including a capital return, we made about 6 times our money on that. This year, the best performers in our fund have been, it's just across the board in everything except for the 2 or 3 things which I thought were going to drive performance. But we've got a position in an asset play, which is something that we do. Probably it's not the sort of investment that Owen would tell you to go into, but I spent a lot of time doing a deep dive research into a business that owned an asset that I view as worth at least $120 million, and so we were buying that business on market. We acquired 13% of the business at a valuation on average of about $18 million, and that's gone up 2.5 times this year.
Can't argue with that. Okay. Well, we'll take one more from the crowd. Yes.
Tony, do you think this new, I guess, the structure that you've got with your fees is going to be the new norm for traditional fund managers, or do you think there's going to be some commercial viability to it as well?
Oh, it isn't easy. When you talked about me, I haven't earned a fee for the last 2 years. So financial 2018 and financial 2019, I fell short of my benchmark and didn't earn a fee. So in order to go into this type of business and running a lot of you guys sitting out there will look at funds and say, oh, they're just all creaming it. But running a financial a fund is an expensive undertaking. There's a lot of compliance. So I have an AFSL to maintain, need to maintain office staff, and there are a lot of costs out the door. I do it more cheaply than anyone else I know because it's in my nature to behave like that. But so I don't think it'll necessarily become normal. But my personal view is that if you're going to have if you're going to entrust your money to someone, that someone should have made enough money that they don't really need to make money off your money. So it should be the first hurdle is that if I'm going to give you my money, you should have demonstrated that you can make money with it. As to whether it will become normal, I'm hoping to make it normal. So what Jack Bogle did to the ETF industry over the last 40 or 50 years, I'm hoping to do something like that within the microcosm of the small Australian industry to the active management industry. ETFs and passively managed investments speak for, depending on which market, something like 40% of global assets now. It's my view that of the other 60%, about 40% of that within the next 50 years will be managed by fund managers with a zero or near zero management fee that are more investor aligned in the way that I am. A number of the funds that I'm looking to help come to market when my fund closes, which should be in the next few months, when we reach our fund capacity, they might do something like, rather than have zero management fee like I do, they might have a small management fee that helps them keep the door open and pay for those costs, and then they'll rebate that management fee against their performance fee. So the risk the investor takes then is just that they're never good enough to earn their performance fee. So there are a number of different ways that you can do the model. That the way I've done it, frankly, is insane, and it probably shouldn't be. Very few people should behave in the way I have, because it does make your life very difficult. And so unless you're extremely comfortable, it's a difficult way to run a business. But investor alignment has to improve substantially over the next. In simple terms, you just can't have these funds out there creaming 1% or 1.5% or 2% of massive fund bases, and then under delivering. You see, it's blown AMP up. I've been a huge critic of AMP for as long as I can remember, 15 years. They've just had this massive pool of funds. I don't think they've ever had a single fund in their whole universe that's outperformed their benchmark. They just sat there and creamed fees for years, and there's a reason why that business is failing, and that's what it is. The people that operate within that business are salarymen and women. They're not in those positions because they're the best investors. Everyone's a safe pair of hands, just trying to get as close as they can to the benchmark and cover as much of the fee as they can. And I don't think that that's a sensible way to have fund managers invest.
Can we just give Tony Hansen from EGP Capital?